If you're a dentist and you're used to financing all of your equipment through banks or other third-party lenders, I'm going to be showing you an alternative that's going to give you a lot more control over your financing needs and ultimately puts you in the driver's seat so you don't have to worry about not getting a loan from the bank, not qualifying, getting denied, being on their repayment terms, etc. So the first thing is I just want to cover what is the actual cost of equipment financing. So number one, obviously the interest rates that you're paying. You might be paying 6, upwards of 10% on some of these loans for the equipment that you're getting. And the other piece of the puzzle, and this is arguably the biggest piece, is not having control over the loan repayment schedule or over the terms in general. Because when you're going to a bank or another third-party lender to get the financing for your equipment, obviously you're not the one in the driver's seat there. You're abiding by their terms. You don't really have any flexibility or say on how you can go about repaying that. I'm going to show you an alternative once we dive in more. And then the last part and the biggest part is you can get denied. You can't just walk into the bank and 10 times out of 10 get a loan. There might be a scenario where you really need the money to get a piece of machinery or a piece of equipment to expand your business because you're rapidly growing, but you get denied and you can't get the financing for the X-ray machine or whatever it may be. So those are some of the downsides of traditional financing, primarily speaking through a bank, but maybe there's other third-party lenders that you get equipment financing through. Moral of the story is you're not in control, the lender is. The next thing I just want to briefly go over is, the issue here is that you're always the borrower. In this scenario, you're always on the back foot. Again, you're at the mercy of the lender here. You don't really have any say. So if you want to expand your practice and get new pieces of equipment, that equals a new loan. And every single time you do that, you're going to get, you might have the same lender, but you might have multiple lenders involved, and this makes things a lot more complicated. So you're always having to ask for permission, and you're always, and this is the biggest part, is you're always going to be paying interest to someone else. So when you're financing this equipment through these banks, these third-party lenders, that interest that you're paying, that's lost forever. You're never recapturing that interest. It's going in the hands of these other lenders. But there's a way for you to actually recapture that interest and put it back into your own private banking system, which we're going to dive into in a minute. So before we get into the soup and nuts of this video, we have to first really just review briefly, what does a bank actually do, okay? So when you put money into a bank, you make a deposit, they now have a liability because they have to pay you interest on that money. Most of these banks, if you're using this a traditional checking savings account, they're not paying much. They might be paying 0.01%. But needless to say, they still have it's still a liability to them. Your deposit, the money you have in these accounts it's money they have to pay you. They have to pay you some level of interest on that. So what do they do to actually get the money to pay you? Well, they're gonna go lend that money out in the form of loans, whether that's auto loans, home loans, etc., credit cards. So they're using your money to go make money with, and then the money that they make with your money, they have to pay you percentage back for the interest that they owe you for the money sitting in your bank account or accounts, and then they keep the spread in between. So it's important to go over that again because we can do the exact same thing, and that's what I'm going to get into now, and we're going to get into the weeds. So here's the alternative. So if you're a dentist who's frequently financing, not even frequently, but you're making big purchases, equipment purchases to expand your practice and whatnot, if you are just sick and tired of dealing with the banks and you're sick and tired of dealing with whatever third-party lender and you want more control, this is how you can do it. So the way you can do this is you have to utilize a whole life insurance policy. And this isn't your traditional whole life insurance policy that you're probably thinking of. It's not your grandparents, it's not your parents' whole life policy. This is a specially designed policy that's focused on maximizing the amount of cash that you have inside of it. Okay, and if you're not familiar with whole life insurance, to keep it very high level, when you make a premium deposit into a whole life insurance policy, a portion of that is going to go towards the death benefit, which is the actual insurance that you're purchasing. And then the other portion of your premium is going to be allocated to what's called the cash value. Simple way to think of the cash value, think of the cash value as a savings account inside of your policy. As you make these premium deposits, you're gonna build up a cash value over time, and that's money that you have access to while you're still alive. Another way to think of the cash value is think of that as the equity in your policy. Because over time, your policy, your cash value is going to continue to grow. And if it's set up properly, which I'll get into structures in a minute, your death benefit should be growing with it as well. So that equity, or the cash value, that's the equity or the portion that you have access to of your death benefit. You can think about it like that as well. But needless to say, that cash value you build up, that's the money that you can access to do things like purchasing new pieces of equipment. So keep that in mind. Next, I do want to touch on, because this is very important as a consumer to understand this, what to look for and some red flags, is when you're getting a whole life insurance policy specifically for maximizing the cash value so you can leverage it to go buy pieces of equipment for your business, for example, what's critical is the agent who's helping you set up the policy, number one, needs to know what they're doing. Number two, they need to have access to top mutual insurance carriers. So side tangent on that, and then I'll get back on track, is a mutual insurance carrier, the whole life policy holders, they are the shareholders in the company, if you want to think about it like that. And the benefit is the whole life policy holders are always prioritized first. And secondly, since you are essentially a part owner in the company, you get to participate in a percentage of the company's profits, and they pay you that in the form of a dividend. So circling back to what I was talking about first, is the agent needs to know what they're doing. So what that means is when they're designing or setting up these whole life insurance policies, there's ways to modify them or change them. It needs to be modified and changed in a way to where you, the policy holder, are getting the absolute maximum amount of cash value in your policy, and the agent is receiving a commission pay cut, if you want to look at it like that, but they're receiving a reduced commission so that you can have that cash value in your policy. Because a lot of agents out there will set up a policy to where it's maximizing their commission, but you as the policy holder, you're going to have a lot less cash value in your policy, which is an absolute no-go for this strategy that we're talking about. So again, agent needs to set it up properly. Number two is it's going to be your job to fund the policy properly. So the agent can set it up, properly all they want, but it's going to be, you're going to have to do your part, hold up your part of the bargain and actually fund it appropriately. Okay. And then the last thing I want to talk about is those mutual insurance carriers. So it's absolutely critical that you're using a mutual insurance carrier to do what we're talking about. You can get a whole life policy with virtually any life insurance carrier out there, but if it's not a top mutual carrier that has been consecutively paying dividends for well over 120 plus years, they have a great track record of paying out claims, and there's proof of performance with their policies, meaning the policies that have actually stood the test of time and have delivered on what they said they were going to deliver or exceeded expectations. That's even better. You want that proof. That's very, very important. So mutual insurance carrier is a must when we're setting up a whole life insurance policy for maximum cash, okay? Next thing I want to talk about is the cash value component again. So the reason why we want to set up for maximum cash is because if you make a deposit or a premium payment into your policy, you could have cash value available to use, to access, as soon as 30 days with a lot of these companies, 30 business days, if not sooner. So if we're setting it up for maximum cash, I'll give you an example. Like if you put in $10,000 into a policy, you might have $8,000 available up front to utilize for what we're talking about. Now it all boils down to design again, and then the carrier you're with, but you might have 80% of your first premium available to access within the first 30 days. So if you're someone who wants to start utilizing this concept relatively soon, you can do that, okay? You can do that, but it's going to boil down to the structure. So that's really important. Now, that's just like, I want to keep it very like high level. Again, I'm not going to get too in the weeds with policy structure. I have other videos really deep diving on the nitty and gritty there, but I just wanted to give you a brief overview of the setup of these whole life policies, because especially if you're familiar with whole life insurance, maybe someone's approached you before talking about this. This is not your traditional standard whole life insurance policy. I just wanted to make that very clear. So now let's tie it in. How does this work for dentists? And what we're talking about, utilizing a whole life insurance policy to satisfy the financing needs in your business. In this context, it's called the infinite banking concept. Not super important, but you'll hear people talking about it. Infinite banking, be your own bank. That's essentially what we're doing here. We're using a whole life insurance policy to replace banks and third-party lenders. So you having this policy and building up cash value, think of that, that's your bank. That's money you have access to, and I'll get into the pros and cons of that later in the video. So how does this actually work for a dentist? So number one, this is very powerful if you start funding it during your high income years, okay? So during your high income years, I mean, that's where you can really stuff a lot of money in these policies and build up that reserve or build up that cash value so you have enough cash to really make sense of utilizing it. Because the one thing with whole life insurance you need to know is the first year of these policies is always the worst year. No matter how you set them up, you're always going to have a negative hit on your money in the first year. And it's usually not till years 3 to 5 where you see what's called your break-even point. So what that means is the premium that you deposited into your policy, you should have that amount or more by years 3 to 5. So if you're funding $10,000 a year, for example, by year 5, you would have put in a total of $50,000. By year 5, your cash value should be at least $50,000, if not a little bit more. In that sense, that would mean that you broke even at year 5 because all the premium you put in, your cash value exceeded that. So that's really important to notate. But while you're in your high income years, you can really start to plow cash in here, and that's just going to accelerate, your opportunity really to utilize the policy. Because the more money you have in there, obviously that's going to give you more options when it comes to financing your equipment or whatever else you want to finance in your life, really. So that's something important to notate is, when you're in your high earning years, you can really take advantage of this more. And you don't have to wait till you're in your high earning years to get started, but that's the most advantageous part, obviously, to put money into this policy. And then lastly, I just want to touch on as a business owner, owning your own practice, you're going to get a lot of protection on that money that's in your cash value. So, God forbid someone decides to sue you, the money in your cash value. In most states, you have creditor protection, meaning that if someone sues you, they can't touch your cash value, whatever is in there. So if you have hundreds of thousands of dollars over time, if not more, stashed away in your policy, that money is protected, and you just have that, that peace of mind knowing, okay, if I were to get sued personally or in business, they can't touch my life insurance policy. They can't touch what's in there. So that's just something that kind of gets overlooked, but honestly has a lot of value being in business. You never know what may happen. So that's just kind of like your safe haven or your safe bucket of money, knowing it's protected from creditors, and leads nicely in the next thing I want to talk about is it's protected from the market. Whole life insurance contracts aren't correlated to the market at all. So if the market's completely dumped, whether that's stock market, real estate, crypto, your whole life insurance policy is going to continue to go up in value. Because with whole life, you get a guaranteed rate of return on your money. Typically, depending on the carrier and the product, you're going to get a guaranteed rate between 3 and 4%. And then if you're with a mutual carrier, like I touched on earlier, that's where you're going to get a dividend on top of that guaranteed rate. So with the guaranteed rate and the dividend combined, which is, I have another video breaking down what the dividend actually means, but the guaranteed rate and the surplus from the company, which is the excess of profits that equals your dividend rate, you might be getting, depending on the carrier, 5-6%, somewhere in that range is pretty common these days. So keep that in mind as well. what I want to touch on next when it comes to the cash is like, okay, what can I actually use it for? So you can use it for anything you want. Most commonly, if you're a dentist, you're going to be using it to cut out the bank and finance equipment, but technically you could use it for whatever you want. And this is where, going a little bit off tangent, this is where you could have, you could have a policy for your business and say, hey, I'm only going to use this policy for financing needs, or maybe it's other business needs, like maybe you want to spend money on marketing, for example. You can use it for that. You can use it for whatever you want. And then on the personal side of things, I mean, you could use it to invest in the real estate, do other investments. That's commonly where you'll see this used. Again, technically you can use the money for whatever you want. I'm not an advocate of using it to take vacations and do things like that. I mean, technically you can, and there's people that do, but I'm more in the boat of you should be utilizing the policy for two things. Number one, maybe it's refinancing debt. So that's a huge one. If you have student loan debt still, you could use a policy to refinance the debt and then make payments back to yourself or back to your policy. That's a huge advantage there. And I'll actually make a video. I don't have a video on that yet, but I'll make a video on that specifically. So repaying or refinancing debt's really powerful. And then financing, well, there's three things. Financing things you would normally finance. So if you're going to buy a new piece of equipment anyway, then you could utilize this to do that. And then lastly is, and the equipment can fall into this category, but the last thing is using it, utilizing the policy to go make more money with investments. And arguably, if you're buying like an x-ray machine or whatever it may be for your practice, that's an investment in your business. It should make you more money. But yeah, that's really the main thing though, is you should be looking at how is this policy, utilizing the policy, going to make me more money? And that's just my personal opinion. Again, you can use it technically for anything, but I wouldn't recommend it using it if it's not going to make you or save you money in one way or another. So very important. Next is what I want to talk about is just going about an example here. So if let's say you need a $50,000 x-ray machine, what is this actually going to look like? So if you need a $50,000 x-ray machine, keep in mind, you need to have enough money in your cash value. So if you want a $50,000 x-ray machine, you have to have, well, you're gonna have to have more than 50,000. Typically, you're able to borrow up to 95% of your cash value. So for easy math, if you have $100,000 in your cash value, you'd be able to borrow up to about $95,000 of that. So if you need a $50,000 x-ray machine, you have $100,000 in your cash value, this is what the process would look like. So instead of going to a bank, right, like you normally would, or some third-party lender to get a $50,000 loan, and then obviously you now can get the x-ray machine, and then you'd have to make payments back to the bank or whoever the lender is. By utilizing a whole life insurance policy, this is what you'd be able to do. So you've got $100,000 in your cash value. What you would do is you would go to the insurance carrier that you're with. Very easy, you can call them up. Some carriers have online portals where you can put in a request, but basically you would request a $50,000 loan against the $100,000 that you have in your cash value. So what I'm about to share here, this is where when I first learned it, kind of blew my mind, is when you get this $50,000 loan from the carrier, what's going to happen is your full $100,000 that you have in your cash value, that's going to stay fully intact, meaning that full $100,000 is going to continue to earn interest and dividend on it as if you never touched the money in the first place. So that's the power of utilizing these policies for financing, is your original bucket of money, if you want to look at it like that, is going to continue to grow and earn interest in the background. Meanwhile, you have a loan against it for, in this case, $50,000. You can use that $50,000 now to go purchase the x-ray machine in cash, and then you can make repayments back to your policy completely on your own terms. So the pause there, I know that was a lot. I need to circle back or touch on something else. So when you're requesting or calling up the insurance carrier for this loan, keep in mind, there's not going to be a credit check. Unlike traditional financing, there's going to be no credit check. because it's life insurance. The money that you have in the policy is yours, and there's contractual provisions in the policy that give you it's a loan provision. So you have a contractual right to request these loans, and the life insurance carrier you're with cannot decline it for any reason. So that's a very powerful leverage point that you have. So there's no credit checks. And then arguably the most important thing to all of this is there's no repayment schedule on the loan. So when you go, if you're financing an X-ray machine through the bank, for example, you're going to have to abide by their repayment schedule, their terms. Now with a loan from the life insurance carrier, you can decide how and when you want to go about repaying that. Now keep in mind, there is going to be an interest rate for the loan from the life insurance carrier, but you have to keep in mind, you're going to be earning interest and dividends inside of your policy still. So in some scenarios, like in this scenario, you might actually come out ahead to where your policy is earning more than the loan cost. So that's a topic for another video, but just know there is interest on the loan, but the way you should look at it is the interest that you're paying on the policy loan, that's your control cost. So if you have a 5% interest rate, which is pretty common across the board, 5-6%, somewhere in that range, depending on the carrier. If you have a 5% interest rate on this $50,000 loan, look at it as I am paying 5% interest to fully control this $50,000 or this bucket of money. Because again, what does control mean? It means you can decide how and when you want to repay back the money, which is critical. So and here's a scenario to think of for all of you dentists, is if you're financing an X-ray machine through a bank, right? And you have to abide by their terms, and let's say something happened in your business or your practice where you're having cash flow problems and you're having a really hard time with coming up for the money to pay back the X-ray machine. Well, with financing it through your policy is, remember, you're using the insurance carrier's money and then you go and purchase that X-ray machine in cash. So you own it free and clear. Now the thing is, you have to make repayments back to your policy, but remember, you have control over how you do that. So if you needed to pause repayments, for example, let's say a good example is during COVID when everything shut down. Like if COVID really affected your business and you financed that X-ray machine through your policy, you could have completely halted repayments to that X-ray machine, or rather back to your policy, for 2 years if you needed to restabilize and do what you needed to do to gain more cash flow. You could have totally done that, no problem. And then year 3 or 3 years later, you could have started back up on making repayments on that loan that you had for the X-ray machine. So that is the power of utilizing whole life insurance to do or to finance the things that you would normally be financing in your life, because it gives you control. And I'm going to keep emphasizing that, is the control aspect. It gives you control, and you're not losing opportunity cost on your original dollars. So what I mean by that is, let's just say, you are financing through the bank and you're paying them interest. Well, you're losing the opportunity to ever earn interest on that money ever again. It's going away. It's going in the hands of the bank, right? Now, the other scenario is you're paying for something out of cash. You have $50,000 in your bank account and you just use the $50,000 to pay the X-ray machine. That's great. You own the X-ray machine outright. You don't have any payments on it, but that $50,000 that you utilized to purchase it, you no longer have the ability to earn interest on that bucket of money ever again. It's gone. It left your account. And then the third option, like we've been talking about, utilizing the whole life insurance policy, the money that you build up in the cash value, when you leverage against it to go purchase, in this case, the X-ray machine, that full bucket of money that you have inside of your policy is going to continue to earn interest and dividends and go nowhere but up, because you have those contractual guarantees in place to give you that guaranteed rate of return. And then again, if you're with a mutual carrier, you're going to get dividends. So that's why it's so powerful, is you're never losing the opportunity cost to earn interest on your money, and you're also having that control aspect and not needing to go to traditional lenders. So again, this is really for if you're someone who's got the capital to, number one, really plow into something like this to build up that reserve or to build up your cash value, and you're just sick and tired of dealing with the banks or other third-party lenders, this is where this could be very, very powerful for you. And I'm just touching on the financing aspect of it. There's other aspects to the policy, like I touched on a little bit, like the creditor protection, and then it's life insurance at the end of the day. There's going to be a death benefit component to it. So there's just a lot of benefits that you can get as a dentist utilizing this if it's set up the right way and you fully understand what you can do with it. Which does lead me to something else I left out is when it comes to having control, and this is where this is very powerful, you technically don't have to pay back the loans that you're taking against your cash value, and here's why. Remember, this is a life insurance policy at the end of the day. So with your life insurance policy, you're going to have a death benefit. When you pass away, and I say when because we're all going to pass away at some point in time, we don't know when. When you pass away, the insurance carrier is contractually obligated to pay that death benefit out to whoever your beneficiaries are. It might be your family, could be your business in this sense, but whoever your beneficiary or beneficiaries are, the insurance carrier has to pay that money out no matter what. So if you had, let's say you financed this x-ray machine and you didn't make any repayments on it, for example, and remember there's interest on the loan, so the interest is going to accumulate on the loan. So let's say it accumulated to $70,000, so that 50 grew to 70, and you passed away and you didn't make any repayments on it, and you had a death benefit payout of $500,000. Well, the insurance carrier is going to look at it like this. They're going to be like, okay, we owe you $500,000. You owe us $70,000 because you didn't repay it when you took that loan. We're just going to pay out the difference to your beneficiary. So you take the 500 minus the 70, they only have to pay out $430,000 in this example to your beneficiaries. So that, you have to wrap your mind around that, because that truly shows you how much control you have over this type of loan or loan structure slash this type of way of financing. Because you have full flexibility on when and how you want to go repay it, but if you really wanted to, you could technically kick the can all the way to the end and not repay it back at all, and it just comes off your death benefit. Your family, your business, whoever you're leaving the money to is just going to get less money. So if you're strictly looking at this policy as a financing tool, that's absolutely something you could do. Now, personally, I'm not, and I don't recommend you entertaining that. Even though you can, doesn't mean you should necessarily do it. It's one of those things. If you read a book called Becoming Your Own Banker by Nelson Nash, very, very powerful book. It's really a must in terms of your foundation for infinite banking. He really emphasizes like what's called don't steal the peas. In other words, don't steal money from your bank. You have to repay. If you're gonna be your own bank and you're gonna be an honest banker, when you take loans against your policy, you need to pay yourself back. So a good habit to get into is when you're taking these policy loans is you repay the loan as if you were paying it back to a bank. So you create a repayment schedule for yourself and you stick to that as if you had to do it for the bank. The thing is, like kind of like your parachute, if you will, is if you do get into a crunch like we've been talking about and you can't make the repayments, you need to pause them for whatever reason, that's where you have that control to where you can pause repayments, no issue there, and then continue it back on at a later date. But you don't want to go into it with the mindset of, cool, like I'm just gonna buy and finance these things knowing I don't have to make repayments right away. Not a good mindset to be in. Just know, yeah, it's your parachute, it's your backstop, like you have that to fall back on. And that's why financing this way just gives you a lot of peace at the end of the day, because you know, okay, I'm not going to have the bank or I'm not going to have the insurance carrier chasing me down because I missed a payment or I missed a couple payments because I had cash flow issues within my practice or whatever the scenario may be. Life might have happened. But anyway, that's really what I wanted to cover with you guys in this video. So again, if you're the dentist out there that's just really sick and tired of dealing with the banks or third-party lenders for all of your financing needs to get equipment and whatever else it might be, there's an alternative for you utilizing a whole life insurance policy. So I hope you got value. If you want to book a call with me to really just dive into this more to see if it makes sense for your situation, because again, this isn't some magic pill, it's not a one size fits all, but again, if you're that dentist out there that is consistently needing to finance things and you're just sick and tired of dealing with these third-party lenders and banks, then this could be a very powerful strategy for you. So if you want to see if it makes sense for you, we can take a look at your numbers. You can book a call with me in the description. It should be at the top. You'll see my calendar. Just click on that, book a day and time with me there. And other than that, you'll see a recommended video down below. Click on that and I'll see you in the next one.